Hi guys, thanks for tuning in to another episode of Nuggets News with our regular monthly update with our friend Martin North. How you going, Martin?
Yeah, good. How are you going?
Very good, thanks. And I've got to give you a big congratulations. You guys passed 20,000 subscribers on YouTube.
Yes, bit of a milestone, really. This time last year we had 5,000, so something's happening in terms of growth. Somebody rather wickedly said, "Well, what you're doing is you're tracking the amount of mortgage stress in the system, right? As that grows, your subscription-based growth." But no, it's good. It's good that more people are actually tuning into some of the perspectives that we have, and using data to be able to inform. I think is what we're about. So we're very pleased to have crossed now at 20,000, and I guess looking for 50,000 as the next one.
It's quite funny for us. Obviously, our subscribers go up when cryptocurrency goes up, and when it went down a lot, it's just dead. But everyone owns a house, and a lot of people have a mortgage. So I think when it goes down, you guys get more subscribers.
That's probably true. In fact, yeah, certainly with the uncertainty over the last half year, particularly, and with the rate cuts and everything else, more people are saying, "Gee, what is really going on?" and trying to get an alternative view. So that's where perhaps DFA can help.
Yeah, so just in general, before we get into our top 10 slides, I guess the election has been digested in a lot of ways now, and the dust is starting to settle. We've seen a lot of good headlines from the mainstream saying that housing's likely to pick up and the bottom's in and that sort of thing. Is that what you've been noticing as well?
Yes. So the mainstream story, particularly with those related to property, is boom time ahead, interest rates will be lower, lending will be freer. Great time to buy. Property has come off 10, 15% or more. Get in now before it starts rising. I'm not sure that's the true story, but that is certainly the one that's being preached. And of course, that's based on average data. It's based on people with interests because, of course, they're trying to talk the property market up. And I think reality is a little bit different. There has been a slight uptick post the election and post the rate cut, but only very slight, much less than people perhaps first expected. And my own view is that I think people are much more sanguine about what's going on. They're much more aware of the risks in the system. And frankly, they recognize that if interest rates are being cut, that's a sign not of strength, but it's a sign of strong weakness in the economy and, more weakness ahead.
Yeah, we'll tie this all together at the end, but I tend to agree, and people do need to realise that the two big media giants in Australia do have ties to Domain and realestate.com, don't they?
They certainly do have strong connections, and if you look carefully at the people who've been spruiking, a lot of them are either directly or indirectly connected with the property sector. And I understand the rationale of saying, property is so important to Australia, and we know that if property is bubbling away, that supports the economy. The reverse is also true. But frankly, telling half-truths to try and get people back into the market at this stage in the cycle is, frankly, pretty damn irresponsible in my view.
Yeah, okay. So let's dive into it here. The first piece of data we have is the latest jobs data, and I think we have more coming out today. But we both personally, I think, we're looking for unemployment to start to tick up slowly.
Yeah, so this is the data from last month. The latest data will be out later today. But yes, it'll be interesting to see whether the upward tick in unemployment continues. So we know that underemployment is rising. We know that unemployment is now rising off its base. And of course, the Reserve Bank has said that they're going to look at the employment numbers as one of the key guides in terms of whether they should cut rates further. The trouble is that we're seeing very weak jobs growth now in the retail sector. And in fact, retail is probably in recession, according to the latest NAB data. And we know that the construction sector is off. We know that there have been more construction firms who have folded in the last month. So it's hard to see where the jobs growth is going to come from. So that's why my personal belief is, and other economists are also saying it, that later in the year we could be up at 5.5% unemployment rather than a 4 in front of it. And yet the Reserve Bank recently said they believe that unemployment rates could go lower, and that effectively to get inflation up, they need to have unemployment down below 4%. Or 4 and a bit percent. So there's something weird going on between what the Reserve Bank wants and what the data is actually showing at the moment.
Yeah, they almost admitted that the new way that it's calculated, things should be pushed even lower in terms of that unemployment, as you say. But they've definitely been hanging their hat on this to some extent, which leaves them with more egg on their face, I think, if it turns up.
Well, that's right. So they were looking beyond the low inflation because we're well below the inflation target, and maybe saying, well, inflation's low, but that's okay because unemployment's low. But if unemployment then starts to bubble up, that just shows you that there's long lengths of weakness in the economy. And, we've been talking about this for a little while. There are signs of weakness wherever you look, I think.
Absolutely. So next up here, we've got GDP. And as you say on this slide, Martin, this was pretty horrible.
It was horrid. I think it was much expected. The point to make on this chart, there are two. The first is the contribution side of it. So households very weak. And, household consumption has typically been half of the GDP growth, but not so now. But the other one is that on a per capita basis, we're now in recession. So, we're growing the economy because we're having more people come in, and therefore the total numbers get bigger. But on a per capita basis, now 2 quarters plus in recession. And that says that for many people, they're not seeing any benefits of the so-called growth in the economy.
And that's something that we've really focused on lately. But this next slide ties into it really well, doesn't it, when we see that disposable income now shrinking. But the thing that I think is super interesting is government share of spending.
Yeah, so what's fascinating here is, and people have been saying in my surveys for the last 4 or 5 years, income is not growing. We are really struggling simply because of the cost of living rising and income's not. And this chart just shows you, firstly, that the real disposable income per capita is falling. It's been falling since 2012, pretty much. That is a reality for many people. So, all this talk about 2% plus in pay rises, it's not working for individuals. So at an aggregate level, because we've got more people working, the jobs is higher, and therefore the income may be higher, but on a per capita basis, it's not translating. And then the other chart, and this is the real killer, the only thing that's supporting the economy at the moment is, firstly, the high iron ore price, well up above $100 US dollars. Yeah. But the other is government spending, right? Both on infrastructure, on things like the NDIS, and other sorts of support, like Centrelink support. Those are now supporting the economy. So 80% of the growth comes from that sector. It's remarkably high. And yet we had the government just before the election saying what a wonderfully strong economy we've got. No, we haven't. We haven't got a strong economy at all. Business investment is very weak. Household consumption is very weak. The only thing that's saving us is an abnormally high iron ore price and massive government spending. And of course, the question there is, if they're going to have to spend that much, how are they going to get back into balance or into positive territory, which of course is what they were claiming before the election.
Yeah, and when we look at that number, it's reminiscent of the GFC when they were forced to ramp up government spending as an emergency measure. And as it really trailed off there, that's when they should have been raising rates in my mind throughout 2012, 2014, when everything was going so strong. Why were rates at these emergency low measures when things were going okay? And here we are again, right back up at 80% and growing, so reliant on government, and that private sector is just not working.
Yeah, no, we stuffed up. So post the mining boom, we didn't invest. We should have invested. We should have taken rates higher. We should have throttled back the debt, encouraged business investment, because, we just don't have now the foundation in the economy to be able to support us through this next down cycle. So unfortunately, bad policy comes home to roost eventually.
Spot on, Martin. So next up, we've got the RBA, and we've been talking about this from all sorts of different angles, Martin, but disposable income growth.
Yeah. So this was a chart that Phil Lowe trotted out just after the rate cut. And he's basically still believing that income is going to bounce to more than 4% later in 2019 through 2021, right? Disposable income. Now, the reason that they're saying that is because they think that the rate cuts will actually translate into lower mortgage repayments, and therefore people will have more money in their pockets. And they're also assuming that the tax refunds that are still caught in Parliament but will come through. I think that's what they're suggesting. But to me, that sort of jump up, they've been consistently wrong for so long. And I have to say, I'm just questioning what they're thinking, because I can't see how we're going to get from around 2% to 4%, in a few months. It doesn't make any sense to me.
Yeah, and I think I shared something on Twitter very similar from the US during the week, where every year they say, we'll raise rates next year, we're getting to 3%. Every year it's the next year it's going to get better. As you say, that is incredible that they're forecasting within months things are just going to be magically growing at 4%. But I guess to play devil's advocate, those tax cuts are going to be beneficial for families, a bit of extra cash. But that and the cuts for mortgages, it's not enough to turn things around, is it?
No, I don't think so. And people, I think, if they're feeling uncomfortable about things, will probably not spend it anyway. So it may not actually flow through into the broader economy. They might pay down their loans and those sorts of things first. And secondly, the cost of living is still rising very, very fast for many people. The CPI numbers we discussed, some time back, the CPI number is just nowhere close to what people are really experiencing. So, yeah, I think that the total story from the RBA really is falling apart at the moment.
It's the same for central banks all around the world, really starting to lose credibility. But housing credit is still growing, but more slowly.
Yeah, so this is the continuation of the trend that we've seen. So total credit is down a bit. Unoccupied lending is still growing at more than 5.5%. It's investment lending that's way down. But the other point to note there is the business lending is also down. And the fascinating thing also in this statistic is that the broad money number is higher. And I have a feeling that since the start of the year, the Reserve Bank has been quietly trying to stimulate the economy by increasing money supply. And that's why the broad money number is up. So that's another, if you like, background measure to try and actually push the economy in the right direction. But the story is, so far, we've seen no rebound in credit growth. The next couple of months will be interesting, post the election, post the rate cuts. Will we see lending recover? And of course, as we said before, the rate of credit change is a fundamental link to what house prices are going to do.
Yeah, and do you just want to comment on the personal credit figure that's shrinking there, Martin?
Yeah, so it's quite interesting that people are actually not using their credit cards as much. They are using things like Afterpay and other forms of credit, but the problem is that households don't have the capacity to borrow more because they're so locked in with mortgage debt. So effectively, personal credit is continuing to go down. That's not a good sign. That's actually a sign of households in difficulty. And if you actually drill further and say which households are the ones that are borrowing the most, they're actually the ones in mortgage stress. So what we're finding is that debt is piling on debt is piling on debt. But across the total economy, consumer debt is actually falling at the moment.
Yeah, I'm a little bit shocked at how Afterpay's got all this attention, and there's a few other copycats out there now. They really are just ways to kick the can down the road and pay for something later and go into more debt. So are those statistics harder to get and they don't fall into that personal credit statistic?
Well, Afterpay doesn't actually provide credit, right? What they do is provide you a facility against your credit card. So effectively, Afterpay debt sits in the credit card bucket.
Okay.
Right?
Yeah.
The reason Afterpay can do what they're doing is they're not a lender and therefore don't actually have to keep to the rules regarding responsible lending. All they are is a facilitator via a platform to use existing payment mechanisms differently. And that's the thing that people haven't quite twigged with Afterpay. So it's quite a smart model, but it is actually putting a lot of people into difficulty. And I think about 1 in 6 people who've used Afterpay have got into difficulty financially as a result of it. So it's a big deal.
Yeah, I guess that's what I was trying to get at there, that I think it's another way for people to get themselves in trouble.
Yeah, well, absolutely. But the point is they're using their existing debt mechanisms, credit cards and things, rather than Afterpay offering new credit cards and things like that. It's a different model. So that's quite interesting.
Cool. Next up here, we've got household confidence, and this is the election bounce that we've been talking about and has been in the media a lot.
Sure. Yeah. So this is the DFA data, and we've seen a little bit of a peak up after the election results and after the Reserve Bank cuts, but it's a very anemic recovery. People with mortgages were just slightly more confident, but they're still in negative territory, around 90. 100 is neutral, so 90 is below. Even those that actually have no mortgages, there was almost no bounce. So those we call the free affluent group. And then those who are renting, a little uptick, perhaps because we've seen rentals getting squeezed, so more people are actually being able to rent for less. But no, there's really little evidence here of a significant rebound. And in fact, the Westpac data that came out yesterday also pretty much said the same. There was a little bit of an uptick in property, particularly property investors. We've seen the same in our data, only very small. But everybody else is really concerned about their financial situation. Their attitudes in terms of spending are still very tight, and the overall confidence is looking pretty sick. And we had the ANZ data pretty much saying the same. We had the NAB data looking at the business side, and business confidence was a little bit up in some areas. But if you look at the fundamental indicators, there's little change. So far, not a big bounce, The question will be, will we see more of a bounce in the next couple of months, or whether we've seen it and now we're going back to where we were? So we'll have to watch that.
Yeah, if you had have only just read the headlines, you would have thought that bounce was a fair bit bigger. So it's going to be interesting to see if that does follow through next month, or that's all we get, and that's going to be very interesting.
Well, if that's all we get, the Reserve Bank will have to cut again and again. The trouble is, people are catching on to the fact that just because you cut rates, that's not good news, right? That's an indication of a flawed economy and pressure on the economy. And frankly, if the Reserve Bank goes into negative interest rates and QE, as they probably will later, people have woken up to the fact that this is not necessarily smart strategy. So they're not going to suddenly turn around and say, right, let's go start spending, right? I think people have got a little bit smarter. And I think around the world we're seeing this. So if you look in the US where QE may well come in, we're looking at Europe where it's already happening. They've got negative interest rates in the Eurozone already, and they're going to do more of that. People are beginning to question whether this whole strategy of, just inflate the economy by actually creating more debt is actually going to be sustainable. And so I'd be interested to see whether, in fact, people, do start spending down the track, or whether they will hold their wallets tight. If they do, we don't see a bounce, and therefore economy will continue to battle away, I guess.
Yeah, and we saw Occupy Wall Street in the US, but people probably weren't familiar with these terms in Australia 5 or 10 years ago, whereas now, definitely our viewers, they know that QE and money printing can lead to inequality and the wealthy getting rich, and they might not say that this is okay to do in Australia. It could cause a bit of a geopolitical scene.
Yeah, well, you end up with the profits being privatised to the 1%, but losses being socialised to the broader community, right? That's the fundamental philosophy behind what QE does.
Yeah.
And people are basically saying, that's not fair. The middle class in the US is getting compressed. Households in Australia are finding it a real struggle at the moment. And yet we're supporting our banking system. Bankers are still getting big salaries. And so there's something not right about this whole thing. And frankly, the International Bank for International Settlements and the Financial Stability Board and the central bankers, they're actually looking after the financial system rather than the real economy. And the problem, I think, now is people are waking up to that. And so it'll be very interesting to see how this plays out.
Yeah, even in Italy this morning, there was headlines about bail-ins on safety deposit boxes. This stuff is getting crazy.
Absolutely.
So mortgage stress is still rising, and this is another one that we want to keep an eye on, this trend. If they cut rates, and if we get 1 or 2 cuts and mortgage stress keeps rising, that's when people say, hold on, this isn't working.
Sure, that's right. So remember, we're looking at cash flow, so money in, money out, and this is a part of our modelling. And post the election, mortgage stress is still rising. This is till the end of May, so we haven't really seen the impacts of any rate cuts yet. Remember that the rate cuts won't actually take effect for a few more weeks yet, right? And remember that the tax refunds that are meant to be there won't come through for a little while. So you could argue that it's too early to see any bounce. I'll be watching this. So if we start seeing mortgage stress easing off because incomes start to rise, because cost of living start to actually get easier, then that will be good news. But there's no evidence in the data yet. There's more than 1 million households struggling with their mortgage. Default rates in Western Australia are now above 3%. The same in the Northern Territory. They're lower in the eastern states, but also rising. And the latest data, as you can see on the next slide, actually makes that point, right, quite nicely. Because it shows that, in fact, pretty much across the country now, mortgage arrears, according to Standard & Poor's, are actually rising. And they make the point that if arrears continue to rise in the eastern states, the populous states, that's a big deal for the economy, because the numbers of people involved are just a whole lot bigger. And everyone's now saying it looks as though default rates will rise ahead. And mortgage stress is probably 2 to 3 years ahead of where default rates will be. And we were forecasting a couple of years ago higher delinquencies in Western Australia based on our mortgage stress. Well, it's now coming through, so expect the same down the East Coast, unless rates get cut dramatically and unless we start seeing income start to rise.
Yeah, we know the housing market has got a lot worse over there in Western Australia in recent years, and just getting to that 3% number. So you could say that things would get substantially worse in New South Wales and Victoria if we got near that 3% number.
It's certainly feasible, yeah. I mean, who knows? It may not, but it doesn't look very flash at the minute.
And just that lagging effect that you describe of those rate cuts, that's also tying the RBA's hands a little bit, whether they pull the trigger straight away or they get some data in the next month or two that's really bad and then they're always behind the 8 ball.
Well, that's very interesting. Yes. Do they try to be preemptive or do they actually try to be reactive? Now, the Reserve Bank traditionally has been reactive. So they wait for things to happen, get the data and react, right? I've argued for a couple of years that that's a mistake. They should have been actually on the front foot 2 years ago. Question is, will they change that or will they continue with the same model that they've always had, which is, well, let's see the data and then make a decision, by which time, as you say, the door's shut, the horse is bolted, and we've already got the issues.
Absolutely. Next up here, we've got bank funding. And I guess we're in an interesting situation now with the US putting rate cuts back on the table at a time when Australia's cutting rates. So it doesn't really make our banks look more attractive.
Yeah, so the BBSW is effectively the rate for funding locally, and it's going down, right? So remember that we had a positive number until quite recently, but now it's negative. And what that means is that the banks, in theory, have more capacity now to spread some of those margins and effectively give some of that back. The question is, will they? Of course, they've had the rate cut. Most of the banks have passed on. They said they'll pass on the 25 basis points or 18 basis points or 19 basis points if you're the banks. How much of that will get passed through? And the banks are still struggling now because as the margin compression continues, what it means is their ability to be able to actually pass margin through gets more and more compressed as they approach zero. So it's a big deal.
Yeah, and that's why we saw ANZ not pass it on, and there was one other bank as well. Yeah. Next slide here we've got is prices in most centres continuing to fall.
So I just thought I'd show this one. This is from the CoreLogic data over the last year, and basically prices are still sliding in most centres. You can argue that Adelaide's not looking too bad, but Perth is significantly down, Sydney and Melbourne. But these are averages, right? And so, seeing 12 or 11 or 10% average falls may get people thinking, well, it's not too bad, is it, right? But the point is averages mask. And what I wanted to do was just to show on the next slide what that means in practice. So here is some more specific data. Now, this is out-of-date data by a month or two, right, because of the way that CoreLogic reports the data. But you can see that in North Ryde, we've had median values fall by, wait for it, 31.2%, right, over the last year. 31.2%, right? In Frankston, it's more than 10%. In Hurstville, it's more than 17%. And in Paddington, right in towards Sydney, it's more than 14%. Now, those falls are very significant, right? Because what that means is that households will be in negative equity. And one of the things that we're doing now is we're starting to report negative equity down at the postcode level because those national averages mask what's really going on. And it's interesting that the Reserve Bank recently reported on negative equity and said around 3% of households across the country are in negative equity. But if you look at their calculation, what they actually did was they applied these average price movements at a very aggregated level, which means they missed all of these big falls in specific postcodes. So if you're going to do calculations around negative equity, you have to get granular, firstly. Secondly, you have to take account of the fact that in a falling market, if you're forced to sell, you won't get top dollar. You'll get a for sale value, which will be lower. And thirdly, you have to include the cost of transaction. So we've done all that. And we think there's a much higher percentage of households in negative equity now. And it's spread across the country. But places like North Ryde and Hurstville would be two examples in and around Sydney where people are in difficulty because they bought with a 90 to 95% mortgage and suddenly now the problem's worth a whole lot less.
Yeah, and we do have to say that there's still some good property out there in certain areas that has remained flat or maybe even kept going higher, and that also masks those bigger falls at the other end of the spectrum, doesn't it?
Yeah, that's the point. So, some properties in some locations are still going up, right? And particularly prime property on big plots, particularly houses in some places. But your marginal property, the property in less popular areas, the properties that are actually in areas where there's been massive high-rise development, they're the ones under significant pressure. And you can look over in Western Sydney, you can look over in Perth, north and south of Perth in all those developed areas. You can look around Melbourne, in sort of Narre Warren and places like that, where there have been significant price falls. And the point I want to leave you with today is don't be deceived by these averages that are being quoted, right? Because the reality on the ground is there are some prices that are pretty good and going up, but there are lots of prices that are falling significantly. And of course, if you're a householder with one of those properties that have dropped dramatically, then you're not going to spend. You're locked into a property with negative equity and you're going to hunker down. And that's the dynamic now I think we're seeing more of.
Yeah, I hate to give you one more question after that mic drop there, Martin, but the proposed 5% down scheme, if we have house prices go down another 5% in, say, 5 months pretty quickly, what happens there with those being underwater? Do we have any information about the government picking up the slack and how that would work in a negative equity situation?
No, we don't. We don't have any details on the scheme at all. I think it was personally, I think it was a thought bubble that was thrown into the election at the point when they didn't think they were going to win. Now they've got to deliver it, right? So they've got to figure out how this thing is going to work. All the evidence around the world says that these sort of incentive schemes create more distortions in the market. They tend to lift prices by the amount. But as you say, if you've got a 5% deposit, it means you're going to be assessed on a 95% repayment, which means that the underwriting standards will have to be higher, firstly. And secondly, if you do drop below that 5%, what happens? How is it going to be picked up? Is the government going to pick it up, or is it going to be cross-insured? We don't know. So a lot of to be announced, I'm afraid, on that one.
No worries, Martin. Appreciate your thoughts as always, and we'll talk to you guys again next month.
Good to talk to you. Cheers.
Thanks, mate.